So let's start our classes. I can show you on the screen. Okay. Okay, do you see my screen?
Yes.
Perfect. So let's do one more example, and then you solve it. Okay, let's start with this example here. Let's assume okay. So face value, guys, imagine $10,000. Coupon rate, let's say 2% per term. Okay, and then you buy the bond here. So guys, you have I want you to find P. Now, if you buy the bond at day 30, and the bond has these characteristics, it pays coupons each 90 days. The face value is $10,000. The coupon rate is 2% each 90 days, just to make it easy. The yield to maturity is 3% each 90 days. Okay, so I want the dirty price, clean price, and accrued interest. Let's say 5 minutes to do this. 3 more minutes, guys, and then we need to start solving. One more minute. Guys, I have just checked the emails from the extra credit. I have Langa Libalele, Lian, Iop, K2 Metze, Blessing, Melina, Bujisani, John, and Ponzo. These are the only ones that I have for extra credit, okay? If I haven't read your name and you have sent it to me, please let me know. Okay, guys, questions, sorry, answers. Someone has an answer here?
So is that first one 200 divided by 1.03 to the power of 60 over 90?
Yeah, wait. Yes, okay, so we have the 2%, so implies basically 200 per period, right?
Yes.
Okay, so let me do this first. 200. And then we have another 200 here. Good. So in order to compute the price, I will do all, and then you tell me the numbers, okay? So the first one here is going to be 200 divided by 1 point. Which one do we use? Yield to maturity or SIP for discounting the cash flows?
Yield to maturity?
Yield to maturity, okay? Because that's what the market is requesting for a bond of these characteristics at a particular time. So it's going to be 1.03 to the power what?
60 over 90.
Right. So this period here, 60. And the rate is for 90 days, 60 over 90, okay?
You're going to get 196.097.
Okay. So let me draw first all these guys, and then you tell me the numbers, okay? Give me 1 second. Okay, so this one is going to be 200 and 103.
150 divided by 90.
Perfect.
And the answer is
Yep.
190.3858.
3839. Yeah, let's say 39. Okay. This is going to be 103 to the power 240 over 90, correct?
Yep, and 184.84.
This one here is going to be 200 divided by 103 power 330. Yep. What do we get here?
179.4569.
Yeah, 46. Yep.
And the last one, 420 over 90, and you should get, or the second to last one, 174.23.
23?
Yes.
23. Perfect. And the last one is going to be 10,200 divided by 103, 510 divided by 90. So what do we get here? Hey, what do we get here, guys?
I have 8375.
8375.65.
65.
Perfect. And then if we sum all these values here, what do we get?
9469. 82.
82. So how do we call this price here?
The dirty price.
Exactly. So this is the dirty price, because what I have done up to this point here is consider that this $200 here, belong to the buyer. Okay. We know that this is not correct, because this piece of the bond, the 30 days, you need to pay some interest on these 30 days. Okay. And this interest rate corresponds to the seller. Do you agree? So this is seller, and this part here is going to be for the buyer. Okay, so this is what is called accurate interests. How do we compute the accurate interest? Remember, how do you compute the coupon, guys? It's going to be $10,000 times 2%, right? Agree with me or not? This $200. So the accurate interest rate is simply what is the interest that corresponds to these 30 days. So it's going to be my $10,000. I need to compute what is the interest rate for that period. So it's going to be 1.02 to the 30 over 90 minus 1. Do you agree? So I have here what is the equivalent interest rate for only 30 days. And then you multiply by 10,000 and then you obtain your accurate interest. So this is going to be 10,000 that multiplies what? So it's going to be 1.02 to the power, sorry. Minus 1. So this is equal to 0.1266622, right? If I multiply this times 10,000, so my
66.2.
exactly 66.2. So this belongs to who? Seller or buyer?
The seller.
Seller. Because guys, this one here is for 30 days, and 30 days corresponds to the seller, the first 30 days. You see that? So from these $200 that I will receive in 90 days, oh no, well, in day 90, the first 30 are going to correspond to the seller because it was his money. This part here, okay, the interest from this 200, this part here corresponds to the seller. So this part here needs to be paid to the seller. Okay, so what is my clean price equals what?
The dirty price minus the interest.
Exactly, dirty price. Yes, minus my accurate interest. You agree? So I simply do 9469.82 minus 66.2. So what is my clean price?
9403.
Point
59.
59. Okay, so this is your clean price, guys. And now it's customary that we don't express the price in dollar terms. So what we do is we simply express the clean price as a percentage of the face value. So and then this is a percentage. You see, so this is going to be equal to 94.0359%. So this is the price. Normally, if you go to newspapers or any magazine, this is the way the prices are presented. Okay, 94%. So it's basically 94% of what? Of the face value. Make sense? Questions, guys? 2 minutes to copy, and then we go to Excel and we do one additional thing before going to the next one. Okay, questions? Questions, guys? Clear? Are you sure? Okay, so let's do one Excel. Let me share my Excel. So let's do one example, okay? So I have the following bond. You see my Excel file, guys?
Yes.
Yes.
Okay, perfect. So what I have is a principal of $10,000. Now I have my interest rate, that is a coupon rate. Basically, this one is my coupon rate, 6%. My discount is what we call the yield to maturity. So this is what we call coupon rate. This one here is my yield to maturity. This is what the market is requesting. And days from starting of operations of transaction. It's on day 20. So the transaction happened in day 20. Okay, so in this case, what I'm doing is I'm computing first the accurate interest. So if you can see, guys, remember for this interest, guys, we use the coupon rate. We don't use the yield to maturity. Yield to maturity only works with the discounting of the cash flow to compute this price. Got it? If you want to compute the accurate interest, you need to use the coupon rate. So as we did before, B3 is my principal, my face value. 1 plus B4 is the interest rate. This is annual, so I need to divide by B6 divided by 360, so 20 days divided by 360. And then you obtain your accrued interests. So it's 32.42. Now, what we do here is, okay, we have all the number of transactions, and it's every 90 days. My principal is going to be 10,000. My interests are always going to be, I computed this already, it's compounded interest rate. So it's going to be $10,000 to 1 plus B4, that is 6%, 1.06, divided by 90 over 360. Okay, and then you do the same for all the periods. And then you have $10,000 here at the end. So what is the total? This is my cash flow at the end. This is the cash flow that we do in the class. So I have 146, and the last one is going to be 10,146.74. And then you start discounting. Remember, this number here is 90, this one here, minus the days that has passed. So that's why it's 70. And then you start summing. This one is going to be 90. So you see the formula. It's going to be 90 days plus 70, etc. So you start accumulating. And then what you do is exactly what we have done in paper. This is going to be equal to my coupon divided by 1 plus B5. B5 is my discount rate, my yield to maturity, 1.09, to the power 70 divided by 360, because this is annual rate. Right? And then you simply compute all the values, you sum all the values, and then you obtain, this is my maturity price, 9,470. My clean price is basically, is this price, is the 30 minus my accurate interests. And then I divide by the price, by the principal, by the face value, and then I obtain my price. So my price is equal to 94.3783%. You have questions, guys? It's exactly the same as we have done by hand, it's simply in Excel.
Prof, could you just show us the formula again in H11?
Yes, H11.
Yeah.
Yeah. So let me move this to be bigger.
Okay, I see
Here,
what is written there.
Okay, so it is this value, the premium, sorry, the coupon, divided by 1 plus yield, this 0.9 here, divided by 70 divided by 360. Like we did in Marina, like we did in the paper, by hand.
Yeah.
It's exactly the same.
Got it.
Okay. Make sense? Okay, so you have, guys, I have gave you the bonds without formulas. What you need to do is you need to start replicating, and I will receive that, I will collect that on the day of the exam. Okay, so before the exam. The quiz 3 is not exam, quiz 3. Make sense? Questions? No questions? Okay, so I can do one more thing here. There is something, guys, that is called duration. Okay, and this is a very important concept in bonds. So what is duration? It's simply the number of periods by which we can recover our investment using the cash flows produced by the bond. Okay, so what is duration, guys, is simply the number of periods in which we recover our investment, the price of the bond, that's our investment, by simply using the cash flows of the bond. Okay? That's the concept of duration. Now, in order to understand duration, remember, how do we compute the price? Indeed, the way we compute the price, guys, is simply coupon divided by 1 plus yield to maturity plus coupon 1 plus yield to maturity square plus the last one is going to be coupon 1 plus yield to maturity to the n plus my face value, what I would call m, okay, just m, divided by 1 plus ytm also to the power n. So this one here is my face value. Do you agree? So this is the way we compute that. Do you remember how do we compute this one here? This is the formula of the price. Okay, we're gonna see that later. Now, what is interesting, guys? I will call instead of yield to maturity, I will use I. Okay, I will just replace this by I, just to make it faster. Okay. Now, what I want to do is, what is the sensitivity of my price to changes on interest? Okay, I will do the first derivative of P respect to I. So Y to maturity is going to be called I. So do you remember your rules of derivatives, guys? This is a fraction. So its derivative of the first one respect to C is 0, minus the numerator multiplied by the derivative of this respect to I. So it's going to be times 1 over the square of this number, 1 plus I squared. Okay. Make sense? So what is the second one? It's going to be, again, minus C. Derivative of this one here is going to be 2 times 1 plus I over 1 plus I to the power 4. So it's basically square this one here. I will do the third one, minus C multiplied by 3. So it's going to be this to the power 3. That multiplies 1 plus I to the power 2 divided by 1 plus I to the power 6. Okay. Then if we continue this operation, we're going to have minus, that the last one is going to be minus C to the power n. And this one here is going to be, so it's n. So let me see, this is going to be 4, 3, let me do this. So this is going to be equal to minus C 1 plus I squared minus 2 times C 1 plus I cubed. Do you agree with me, guys? Minus 3C divided by 1 plus I power 4. Okay, so now I know this one. So this is going to be n times 1 plus I to the power n plus 1. Okay, and plus m minus m n. Okay, that multiplies 1 plus I 1. So it's not 1 plus I plus n. So here we go. So what is my ratio here? So let's take a look. So minus n. This one is going to be 1 plus I to the n plus 1. So this is going to be basically, so let me see. So it's going to be n. This is going to be 1 plus I to the n minus 1. And down, we're going to have 1 plus I to the 2 times n. Also, this one here is 1 plus I to the n minus 1. And this one here is going to be 2 times n. If you simplify, guys, this is going to be minus nc. And finally, minus nm 1 plus I to the n plus 1. Okay, so this is the derivative, guys. So it's simply, what is the change of my price when I have a small change on I? Now, what I will do is I will simply take the minus and 1 plus I to the right, and I will multiply this one here respect to I, and I will multiply this one by 1 over p. So both sides of the equation, I will move this. It's going to be minus 1 plus I, that multiplies c 1 plus I plus 2c 1 plus I squared plus 3c 1 plus I cubed plus nc 1 plus I to the n plus nm 1 plus I to the n. Okay, and this one here, just to keep consistent, this one here, I do this. Okay, so let me change this one here. This is something artificial that I have done. You're gonna see in a minute what I have done this one here. Okay, so this part here, guys, this part here is called the Macaulay duration. And all this part here, so sorry, it's an equal here. And all this part here is called modified duration. Okay, so let's do one example to understand how this works. And you try to do it. So I have an example here. You need to apply this formula here, guys, simply. So my example is I have my face value equals 1,000. Oh, 1,000 only. Let's make it easier. I have my coupon rate equals 5% annual. My yield to maturity also is 5% annual. Coupons are also annual, just to make it simpler. So you pay 1 coupon per year. Okay, can you please compute the duration of this bond? So remember, guys, that P, this P here, has a formula. Do you remember? Where I do this? So let me write the P formula. So from here, guys, you can see from this part here, this is something that we have done before in when we computed how do you call it? The IOUs, remember? So this P, the formula of P, guys, is going to be simply equal to a coupon. Okay, so this coupon that multiplies 1 plus I to the n minus 1 over 1 plus I to the n times I. Okay, so this is the price plus m divided by 1 plus I to the n. So this is basically the price. Right, so you have the formula, you have everything, you have only 5 periods here, so n is equal to 5, so you replace this up to 5, divide this by this formula, and this should be your Macaulay duration. Okay, so let's compute first the Macaulay duration. And later we're going to compute the modified duration. Okay, 3 minutes to do this. Do it, guys, come on. That's easy now to do.
And Prof, the 5 periods, is it something that is a given?
No, I will do
because
that.
I don't see it.
Yeah, I will assume n equals 5 years.
Oh, okay.
No, I need to assume. Yes. just to make it short enough to show the concept. So guys, I will be putting some numbers here, okay? So my coupon is going to be 50, right? So it's going to be 50 divided by 1.05 plus 2 times 50 divided by 105 squared plus 3 times 50 divided by 105 cubed plus 4 times 50 divided by 105 power 4 plus 5 times 50 divided by 105 to the power 5 plus 5 times 1000 divided by 105 to the power 5. Correct? So this is the numerator. Agree with me, guys? Guys, you agree?
Yes.
Okay, now I need to divide all these by P. So multiply 1 times P is divided by P. So this one here is going to be 50. I just apply this formula here. 50 times 1.05 to the power 5 minus 1 over 105 to the power 5 times 0.05 plus 1000 divided by 105 to the power 5. Okay, so this is what you need to compute. Okay, ready? So what do you get here, guys? Please help me with what do you get here? Guys, what do you get here, please? Guys, are you there? Sometimes I feel I'm talking to no one.
I just have the numerator at the moment.
Yeah, can you please do the second part?
Okay.
Thank you. Okay, someone?
I get 0,116.
No, cannot be.
No.
Cannot be. Give me 1 second. I'm in the denominator also. Give me 1 second. Oh. Okay. Give me 1 second. Yeah, guys, I obtained. Please, you need to verify this one here, but this looks more reasonable. 4.55 years. Okay, you need to verify this one here. Okay, but this looks more reasonable. In any case, please check. Okay, now let's use the formula. This formula here. Let's use this formula here. So I have dp derivative of p, change of p respect to change on I, times 1 over p equals 1 over 1.05. That multiplies the number that we got, right? 4.55. So basically, guys, dp. So this is what is called modified duration. Do you agree? Okay, so from here, dPdi times 1 over P equals minus, okay, let me see. Minus 4.33. All right, so what is the meaning of this number? The meaning of this number, guys, comes in the following way. So take a look to what happens. I will do this. Minus 4.33, change on I. So this formula here is very interesting, guys, because it simply tells you what is the expected percentage change on prices when there is a small change on the interest rates. Okay, and this negative number implies the negative relationship between interest and prices. Remember that? So let's do one example. So imagine that my interest rate, okay, increases by one increases. So this implies that change on I equals, this is one example, 0.01, very small change on price. So what do we expect to have in what is going to happen with my price? So this is going to be minus 4.33 that multiplies 0.01. Do you agree? Make sense? So what is this? 4.33 times 0.01. Yeah, of course. So this is going to decrease 0.0433. So you see that if the interest rate increases by a small number, what happens with my price? My price is going to go down by this number here. Make sense to you guys? So now what happens if my price decreases? So let's assume that my change in price equals now negative 0.01, very small change. So what happens with my price? It's going to be minus 4.33 that multiplies minus 0.01. So it's going to be a positive 0.0433. Got it? So that's why we use the modified duration, guys. It's simply to compute also what is going to be the expected change on prices when there is a small change on interest. Okay, now this comes in tandem, guys, with the concept of convexity. I will just mention what is this one here. Okay.
Prof, before you go on, can I just ask you what is that 4.55 years? What is the meaning of that?
Oh, that my cash flows, so my money, the money that I invested, okay, is going to be recovered in 455 using only the cash flows from the bond. So if I just wait the cash flows for 4.55 years, I will receive my money, the money that I invested. Okay, so that's the definition of duration. It's simply the number of periods in which you recover your investment, so the price of the bond, just using the cash flows of the bond. You see, I'm not using here any capital gains. Remember, we have capital gains. We also have interest over interest. Remember when we talk about bonds, what are our sources of income with bonds? We are not considering anything except the cash flow. Okay, and if I just wait for the cash flow, guys, after 4.55 years, my money that I invested at time zero is going to be recovered. That's the meaning of maturity. Sorry, not maturity, duration.
Okay, thanks.
Okay, and what is interesting, guys, is that if we use the modified duration, we use this formula here, and the modified duration, what it tells us, guys, the formula allows us to compute changes on price, percentage changes on price. This is change on P divided by P. It's going to be a negative proportion of the changes on I. Got it? Now, and this is related, as I was telling to you guys, this is yield to maturity. And this one here is going to be the price. Okay, so the price of a bond, guys, is a convex function. Looks like that. Got it? So what we are doing is, okay, so I have a yield, so I have an I, and for this I have a P. You agree? Now, what I'm telling to you, this relationship is a linear relationship. So this relationship, what we have found here, this relationship is a linear relationship. Do you agree? It's something like that. So why I'm stressing that the changes on I should be smaller, that in order to have these changes on price, you know, kind of a good approximation, is because if we move from here to here, you see that, guys, very small, the red line is not exactly the same as the black line. However, we're very close. Got it? Now, if I want to do, what is that change on prices, on percentage prices? If I move my eye up to here, for example, you see the difference? My model is going to tell me that the price is going to fall up to here, when indeed falls only up to here. Okay, so that's what you need to be careful. Careful, guys, that the bonds relationship, yield to maturity with price, is a convex function. Okay, because all this is a exponential function. Okay, we don't have time to express that. The only thing that you need to remember is that if you use a modified duration to compute changes on price given changes on interest, these changes on interest rates, guys, should be very small. Okay, 1%, 2% perhaps, but the farther you are from the original I, you see that the differences between what you estimate here versus what is real life is going to be larger and larger. Make sense? Questions, guys, so we can move. Okay, so now let's go to the last part of the class. So the last part of the class is a kind of a financial accounting. It's a very simple financial accounting. I will show you one method that is extremely useful and extremely simple. Okay.
Sorry, Prof. I wasn't able to copy the.
Oh, yeah. Wait. Yeah. Here we go. Let me move this one here. So 2 minutes, okay? Copy in 2 minutes while I bring my water. Okay, ready? Ready?
Yes.
Perfect. Okay, so now let's go and let's do the final class of the final part of the class. So this is a financial accounting. Okay, so what we're going to understand now, up to now, guys, what we have been talking is about interest rates, types of interest rates, how interest rates are affected by inflation, or projects are affected by inflation, and exchange rates, and we have estimated net present values, internal rates of returns. We have done some tricks of interest rates, simple interest rates versus compounded interest rates. So, and finally, we have done bonds. Okay, so I think you have a very clear understanding of the role of a CFO in terms of what mathematics are needed. Now let's go into financial accounting because that's your role. That's all the thing that you need to understand in order to make strategic decisions when you work in a corporation. The way we are going to work, guys, is a method that is extremely simple. We're going to discuss this in a minute. But what we try to do is we try to create basically the three basic financial accounting statements. Okay, so we have the balance. Let me move this here. So the balance, guys, as you remember, so we are going to divide this into three pieces: assets, liabilities, and shareholders' equity. Got it? And each of them, you have assets that are going to be short-term, and then you have long-term. Liabilities the same. You have short-term, and then you have long-term, and equity. What is interesting about this balance, guys, and this is what is the trick of everything, is that this is an identity. Assets must be equal to liabilities plus equity, okay? So this is an identity. It's not like econometrics that has an error. No, it must be equal, got it? And that's the main identity we're going to be using. Now, there is another financial statement that is called the P&L. Okay, the P&L has a bunch of pieces, but let's say revenues, cost of goods, you have the gross margin. Then you have expenses around here. We have the earnings before interest, tax, depreciation and appreciation. Then you have, let's say, depreciation here. Then you have interests here, interest payments here, etc. Okay, and then you have the earnings before taxes. Then you have your taxes, and then you have your profits. Okay. Now, how do you use these profits, guys? Do you remember? These profits can go out as dividends, or these profits also can go to the corporation. Do you agree? So they can return here. How do we call here? So one part of the equity is going to be called retained earnings. Okay, so this is the way the P&L connects with a balance sheet. Now there is another financial statement that is a cash flow. And the cash flow, guys, is related here. We are going to have cash in the short term. We are going to have a concept that is going to be cash. And this one here is going to be basically this one here. Okay. Now, cash operations, guys, you have cash from operations, so from sales. For example, you buy and sell products. So this is going to increase or decrease your cash flow. So this is called cash flow from operations. But also we are going to have cash flow for investment. So someone, imagine that you wanted to buy a new factory and then you call new investors. Okay, so cash flows are also going to flow to a corporation through investments. Okay, someone is investing in your corporation. And of course, also you can have a cash flow for financing operations, for financing transactions. So these are the three components of cash flows, and this is the way in which all the elements are related. Now, what is really interesting, guys, is that this one here is the identity we're going to be using all the time. Got it? This one here is the one that really is going to help us structure and understand all the three statements in a single round. Got it? The method that we are going to be using is called the Italian method. And you are going to love this method. Okay. It is extremely simple, it's straightforward, and extremely useful. So for some of you that have been are accountants, you also, I'm pretty sure you're going to enjoy this method. It's going to be extremely simple. Questions, guys? No questions? Okay, so now what we are going to open, I send you a file. Nah, where's my file? Yeah, can you open the file that says financial accounting blank 2021?
Yeah, we can, are you asking if we have access to it, or do you want to?
Yes, no,
It's
no.
opened
please,
up right now.
Yes, open that file. So let me open mine too. 1 second, please. There we go. Give me 1 second. Okay. Okay, so where's my file now? Give me 1 second. Oh, it's financial accounting. Financial accounting. What's the name of the file? Financial accounting blank 2021. Okay, good. So I have it here. And let me show you my screen. Do you see my screen?
No,
Not the Excel.
Yeah, now?
yes.
Okay, perfect. So we're going to do transactions and not operation. These are called transactions. Okay, so these are transactions, guys, that I simply created randomly just to show you how the things work. Okay, so the first one, I will do with you the first 5, and then you're going to do the remaining ones. Okay, it is extremely simple. Take a look, guys. What I've created, first of all, is if you go to sheet number 2, so let's call this field. Okay, if you go here, what I've created, guys, is simply I created all the accounts. I will use cash. So all the short-term assets are these ones here. You can put more as you need, okay? But I have created these ones because I know I would use them. I have cash, accounts receivable, inventories, prepaid expenses, short-term investments. My fixed assets are going to be my equipment, my land, my building, and my accumulated depreciation. So all this part here equals my assets, A. Okay, and remember, we want A to be equal to what? Liabilities plus equity, okay? So my liabilities, I have current liabilities. So these are my current liabilities. I have accounts payable, interest payable, sales taxes, short-term interest, and earned revenues. You can add more as you need, okay? But I have done these ones here because are the ones that we're going to be working with. Okay, then I have a long-term liabilities, basically bonds and long-term interest. This doesn't exist, but let's move it like that. And then my stockholders' equity, I have my preferred stock, I have my common stock, I have treasury stock. I will explain you what is treasury stock. I have my retained earnings. Okay, and close to it, guys, I will create two columns. One is going to be called revenues, and the other one is going to be called expenses. So just by rule, revenues are always positive, expenses are always negative, okay? This is the trick here. Revenues are positive, expenses are always negative. And then finally, guys, what I give you is a control column. This control column simply tells me I want to be sure that my assets equals my liabilities, my equity, my shareholders' equity. All right, so that's all. So this one here must be 0 all the time. If you find a number that's not 0, implies that you have a problem in your row. Got it? You understand? So imagine if you have 10 here, you have made a mistake. So this number here always must be equal to 0, always. Otherwise, you are making mistakes. Got it? So, okay, so can we read the first transaction? You know, I do, the first transaction is simply, let's do an initial investment of $200,000, $200,000, 200,000 shares at $1 each. Okay, my contribution comes into 3 pieces. Cash, someone puts 50,000 cash. someone puts a market value of building, $100,000, and someone puts, land market value $50,000 for a total of $200,000. Got it? Do you understand the transaction here? Do you understand what we're doing here? So we're creating our corporation. We're funding the corporation with cash, building, and land. Okay, $200,000 total. So what we do here is, okay, so I need to divide this one into pieces. First transaction, so let's go here. I'm receiving cash, $50,000. You agree? Then I'm receiving land, $50,000, and buildings, $100,000. You agree? And these ones increases what? Increases my common stock. What is my common stock? At $1 each, $200,000. We need to check if we're okay. My control column is 0, so we are okay. Make sense to you guys?
Yes.
Yes.
Perfect. Okay, so can we read the second one? Let's do the first 5, you do it with me, and then you're going to do this alone. So now we said that this one here is going to buy computers, okay, equipment, not for selling. So I will invest $10,000. If I do that, well, I need to invest $10,000. This is cash, so I will put minus $10,000 here. And this $10,000 is going to increase what?
Fixed assets.
Yes, my equipment. Do you agree? $10,000. And of course, if you sum these two, it's 0. So my control column is also going to be 0. So what I'm saying is you don't need to check this, but you know that. Make sense to you? So these are transactions, guys, that only go in the asset side of the equation. Do you see? It's only asset, not necessarily asset, liability, and equity. So that's the thing with the balance. The balance can be a mixture of whatever. You can have also sometimes liabilities, etc. We're going to see that. Make sense? So let's do number 3. Now I'm buying merchandise, $5,000 cash. When its default is going to be cash. I pay $5,000. And this is going to be what, guys? Against what? This is going to increase my inventories. Got it? So let's do one more. This is interesting. Oh, well, I sell merchandise. Okay. Here you need to pay a lot of attention, guys. You see here, when I sell merchandise, I receive cash and sell taxes. So this 3,750 or 60 is made of 2 things: my cash that comes to me and the sales taxes that equal 7.5%. Got it? So remember, these sales taxes I'm collecting only in the name of the state, of the country, of the IRS. This money is not my money. I need to pay this money. It's going to be a liability. I collect the money, but I need to have this as a liability. Got it? And then this is a cost of merchandise. Remember that if I sell something, it should have a cost. This is what is called cost of goods. Got it? So how much money I will be receiving, guys? I will do this here. How much money I will be receiving, cash in total? It is 3,760, correct? Guys, you agree?
Yes, 3,760.
Yes, and then I know that sales tax payable, part of this equation here is taxes, you agree? So my taxes are going to be equal to
262.33.
Yeah, 262.33. I know this is positive, guys, because it implies that I have a liability with the state, with the government. 262. Okay? And now, what I need to do here? This is a revenue. Do you agree? What is going to be my revenue equal to?
$3,497.
Exactly. So and you can see here you have some guidance there. 0.67. Agree? So this part here, 3,497, guys, is this one here. It's basically what from this 3,760, this money is yours, and this money is from the government. Okay? Do you understand? However, guys, and you have a second space here. I give you second space, but you don't necessarily need a second space. Is that in order to sell this merchandise, you need to have something. You have use something. Do you agree? And what is going to happen is that here I have. They say that the cost of this merchandise is equal to $2,800. So this implies that I'm reducing my inventory in this amount of money. And this one here, guys, is what it is an expense. And expenses are always negative, guys. Make sense to you? So what is the profitability of this particular transaction, guys? 697. So I made $697.67 for this particular transaction. Make sense to everyone? Are you with me?
Yes, Prof.
Excellent. Okay, so let's do one more, and then you start doing the remaining ones. So what is that? Oh yeah, I buy merchandise, but I will pay cash, $5,000, and I will have a credit, no interest for 30 days, $12,000. So my total merchandise is going to be valued at $17,000. So it's 512. So I will pay $5,000. I have a loan for how many $1,000? $12,000. Is this correct?
Yeah, yes,
And then my value of my inventories is going to be equal to $17,000. You see, if I sum this is my assets equals 12,000 minus 12 equals 12,000. So my control column is going to be 0. You see? So we are okay. Make sense? This is the way it works, guys. It's very simple. It's very straightforward. And there are some small tricks, but you need to learn the tricks. That's all. Okay, so can you please start working? Let me save this one as a different one, 2001 solutions. Yeah, can you work, please work questions, no, transactions number 6 to 9. Okay, 5 minutes, and then we do this together. Transaction 6 to 9. 1 minute, guys. Okay. Have you finished this one? Guys. Okay, so let's do this. Here is a pay in advance for publicity for next 3 months, okay, cash. So this implies that I have paid in cash, so it's $3,000 decrease in cash. And this is something that's called prepaid expenses, guys. So this is an asset. You haven't used it. So that's why it's not an expense. It's basically like having a bank account. You have paid $3,000, but they haven't provided you with the services. So that's why it's an asset. Then we have to number 7. So how do you do that? It's sell merchandise. Again, you have taxes. You have received cash, and you are going to give them a credit line for $2,000 for 30 days, no interest rate. And the cost of merchandise is $3,500. Make sense? So let's do it. So I have in cash, indeed, I have received this plus the taxes, okay? So I have received this in cash. So I have received 2,300, and I have accounts receivable of 2,000. And here I need to increase my sales payable to $300. And here, yeah, where's my mouse? So here, what I have here, guys, is what is my profit? So it's $4,000. You agree? Guys, you agree? So my revenue is $4,000. Agree or not? Even though I receive cash only 2,300, what I have done is 4,000 is is the value of my merchandise. 300 goes to the government. Right? So my revenue is indeed $4,000. So what is the cost of this merchandise? How much money I pay for this merchandise? 3,500. So it's minus 3,500. And what this does is simply reduces my inventories in 3,500. Do you agree or not? Guys, agree or not?
Agree.
Agreed.
Okay, perfect. So and we need to check our balances, our controls. Yes, we are 0. Perfect. So we are in number 7. Number 8. So now I will provide a computer service, okay? So let me see, this is computer service you provide. Okay. So cash is $4,000, so they're gonna pay you cash $4,000. They're gonna pay you $3,000 in 30 days. The taxes, guys, is $300, okay? And sales taxes credit is 225. Oh yeah, so basically, guys, what happens here, so the taxes are going to be paid. This 300 corresponds to 7.5 of $4,000. And this 225 is the taxes for this $3,000. And according to this transaction, guys, they pay you only the taxes from the cash. Okay, as you're gonna see, guys, this is something that the people don't accept. Normally, they can give you a credit, but they are going to request to you, pay me the sales tax in advance. So basically, they're going to request you to pay these ones here. Okay, but let's go and you're going to see what is the impact of that. I have cash 4,000, and I received 300, so I will receive 4,300 here. I know that $300 are for the government. Okay, here you're going to see in a minute. And then I have accounts payable. My accounts payable is going to be equal to
3,000?
nope. It's going
No?
to be this plus my taxes.
Okay.
You agree? So that's the total cash that I will receive. But this implies then, and here comes the trick, that I owe to the government not 300. I owe, of course, 300 plus 222 plus 225. Do you agree? Because from these $3,000, guys, 225 are not mine, are from the government. So I need to record this for the government, sales taxes. Okay, so what is going to be my revenue? My revenue is going to be $7,000, correct? Guys, you agree with me or not? So it's basically these monies minus the 525. So it's 7,525 minus 525. So this implies that my revenues are $7,000. I don't have any cost of merchandise because you know what? Perhaps you know I can have labor, but in any case, I don't have any cost of merchandise. This is a service. I don't know why we provide the service. I just did it as an example. Do you agree? Do you agree, guys? Now, what is interesting, guys, is that take a look. Revenues are not necessarily equal to cash. I have only $4,000 here. However, I need to already report my 7,000 revenues. You see that? So revenues are not equal to cash, guys. Please pay attention there. Revenues are not equal to cash. Do you have any questions? So we are at 0, so we are okay. So now we can do number 9. Number 9 is you pay salaries. Okay, 3,500 cash. So you pay salaries, and this goes directly to expenses. Do you agree? This is simply an expense. Okay, questions up to now? Okay, let's please do from 10 to 14. Five minutes to do 10 to 14. 2 minutes, guys. Okay, so let's do this. So we pay sales taxes, okay, 1,087, 383 or whatever, this one here. So basically, guys, this corresponds to this money here, right? Do you agree? Is a 1,087.33. So we'll pay minus 187.33. And this one here is going to disappear my debt with the government. So let me see if I have here. Yes. Do you agree, guys? Now, do you see the importance, guys, of charging for interest at a cash? So when they pay you, when you even give credit to your clients, what is more important, guys, is ask them to pay the taxes upfront. Why? Because here you can see from this 525, 300 have been paid, but 255 are going to be paid in the future. The government doesn't care about that. For the government, you owe the government 1,087. You need to pay that directly now, okay? So that's the issue, guys. So that's why normally when you buy on credit, the corporation asks you to pay in advance the taxes, more if the taxes are very large. If they are small, no problem. Make sense? Okay, so now let's do what is next. So I had a loan for $12,000, remember? And this $12,000, I will just pay $4,000. I will have so 4,000 paid, the 8,000 are going to be simply moved for the future. But now these guys are going to charge me the interest of 32.59%. Okay, so this implies the following: 32.59%. So this implies the following: I will pay $4,000. Sorry, paid is negative. This will reduce my loan. Where is my loan? My accounts payable in $4,000. You agree? But also, this will increase a 32.59 interest. So we'll pay this 52 when I pay my debt. So, and this immediately, guys, goes into an expense. You see? So I've done this in 2 lines, but you can do this in a single line. So basically what you're doing is you're paying from this $12,000, you're paying $4,000. But now for the $8,000, they're going to charge you an interest of 32.59. And as soon as you recognize this interest, guys, this interest goes recognized immediately as an expense, even though you haven't paid, you see, but it's already recognized as an expense. You have doubts, questions? Guys, are you there?
Yes, I'm gonna utilize tomorrow to look over the lecture videos and see if I have any questions.
Yeah, perfect. So now let's go to question number 12. 12 is easy. Oh, I'm using the first month of publicity. So basically the publicity advertising company simply did the first round of advertising and they charge you the $1,000. Now, so remember guys that we have paid the $1,000 somewhere around here. Okay, so now it's not going to be a cash transaction. It's simply going to decrease these prepaid expenses by 1,000. And this is now considered what? An expense, do you agree? Okay, so this is a very interesting transaction, guys. The cash was already done in the past. Here. Yes.
Yes, I just want to know with the question number 11, what happened with the 8,000?
Oh, it is here already. I don't need to do anything. Remember, the 12,000 minus 4,000 is my 8,000. I don't need to do anything because it's already considered there.
Oh, I see.
Got it? It's already, you don't need to do anything. You simply subtract the 4,000. So what is left as a debt is 12,000. What you need to do is you need to add the interest for the 8,000. It's going to be 32.59. Got it?
All right, thank you.
Pleasure. So the $1,000 is easy. I'm okay. I need to be sure. Yes, I have everything okay. So now let's go to transaction 13. Payment received for credit. Do you remember we give credit to someone for $2,000? So they are paying this now. So this is $2,000. So as soon as they are paying to us, we receive a positive cash of 2,000, and then we are disappearing this debt of 2,000. So this one here cancels with this one here. So these guys don't owe us any money now. This particular client. So let's do 14. Then I have done 128. What is 128? 128. Oh yeah. We also, do you remember we provide services to these guys and they just paid us part. So now they are paying us the total. They're going to pay us $3,225. Okay, and remember, 225 correspond to taxes. So what I will do is I will receive the 3,225 positive, and this one is going to decrease, is going to eliminate this one here. You see this one here is already canceled here. And remember, I received 225 corresponds to taxes, but I already paid the taxes around here. So that's the issue. So there is a time inconsistency here that is correct from accounting perspective. Make sense? Okay, guys, so you do 15 to 19. 5 minutes, okay? You need to do this, guys, okay? I do this very quickly, but I hope you have been doing this and you're thinking and then you are understanding how the process works. It is a process of thinking here, and you need to do it here in this class because otherwise you're going to be kind of lost. You need to do this here in order to get familiar with the process. Okay, guys, so 5 minutes there. One more minute, guys. Okay, guys, let's do it. Let's do number 15. Okay, so sell merchandise, 3,000 cost of merchandise, 5,000 cost of merchandise, 3,500. This is easy, right? So basically what I'm saying is I'm $5,000, oopsie. I received $5,000, so this is a revenue, $5,000. And the cost of the merchandise is, what is that? What is the cost, guys? 3,500. So this is an expense, cost of goods. And this reduces my accounts receivable in 3,500. You agree? Now let's do 16. What is 16? Pay salaries, again, 3,500. Pay salaries in this case is cash transaction I pay. And this goes directly to my expenses. Now we go to 17. 17 is I issue a long-term bond. Okay, so here we need to pay attention, guys. Huh? We do a long-term bond for equipment, okay? It's going to be a bull 3 years, annual coupons 3%. Face value, $30,000. Long-term coupon payments, 2,700, and short-term coupon payments, 900. So short-term coupon payments means it's going to be paid in this year, okay? And the 2,700 are going to be paid in the future, got it? Okay, so how do we do that? Well, what we can argue, guys, is that let's do first in 2 steps. I have $30,000 my bond, okay, and this is going to create a long-term liability of $30,000. Now, this has 2 components. It has one component that is my interest, my short-term interest, okay, and my short-term interests are basically $900. So this is what I need to do. I need to pay $900. So I can do this $900 here, and this immediately is considered as an expense. Now, what happens with the 2,700, guys? Any ideas? So, any ideas, guys? No ideas? So what happens, guys, with anything that is beyond 1 year is considered as a note to the financial statement. So we're going to have an star with a number in the financial statement, and we're going to see, you know what, there is $2,700 that corresponds to interest that are going to be paid in years 2, 3, and 4 that are not considered in this balance. So they're going to be registered outside the balance. Okay, something like that. See note 25, for example. So the one that reads this balance takes a look to note 25, and this 25 is a creation, guys. So I just put any number. And then you're going to realize that there is $2,700 that are not considered in this balance because it's balance is for 1 year, but it's going to be paid in the next 3 years. Okay, so this part here is okay, but then it comes, I need to use this one here for what? To buy equipment. So then I do $30,000, come to add $30,000 in equipment. Okay, so this is a complete transaction. Questions? This is a really interesting one, so you need to pay attention. 18. Well, 18 is sell all equipment. Okay, I sell for 5,000 and the cost was equal to 7,000. So I'm losing money here. Sometimes it happens. Okay, you have a machinery that is old already, you need it, and then you simply need to sell at a loss. So I received $5,000. So this is an extraordinary income, $5,000 here. And how much this cost to me? $7,000. Okay, then I reduce what? My previous account, my previous equipment. Do you agree? No, 700. So I'm reducing the value of my equipment because remember, equipment is structured at the market price. Okay, so from this $10,000, I'm selling equipment that is equivalent now to $7,000. As you can see, guys, this is an extraordinary income or revenue, and this is an extraordinary expense. So what this means, these two means, I have lost $2,000 for selling my equipment, all equipment, what I call all equipment, at a discount. Okay, so let's do 19. We pay transaction the 8,000 plus the $32. So I will pay minus 8,032.59, and this is going to disappear 2 pieces of the equation. I have accounts payable, remember? I had 8,000 here, so I will disappear this one here. I will disappear this 8,000 here, and I will disappear the 32.59 from here. You see? This one here was an expense already as soon as I discovered this one here, as soon as I realized about that. And once I pay it cash, I don't consider this already because it has already been considered. Questions? Okay. So please do question number 20 to 24. Okay, now 20 to 24, please. Okay, 3 minutes, 4 minutes, guys. These ones are easier. 2 minutes, guys. Okay, so let's do this, guys. 20. I have a short-term bank loan, so the corporation received a short-term bank loan for 6 months. We're going to receive $10,000, and we're going to pay an interest $393. Okay, make sense? Okay, so let's do this. So what I will do is I will receive $10,000. So this increases my accounts payable, $10,000. But also I will have interest payable for 392.3. And immediately, guys, as soon as we recognize this one here, this is going to be an expense, 392.3. Questions? So 21, I use the second month of publicity. Okay, so I don't have any cash because I already paid this one here. What I will do is I will reduce my prepaid expenses. And this is an expense immediately. That's easy. 22. I buy commercial papers from firm XYZ for 3 months, discounted at 12.5% annual. The face value is $5,000 and the discount is 141. So remember, guys, this implies that I'm paying $4,854.9. Okay, so let's do this. So I'm paying minus 4,854.92 for something that is worth short-term investments, something that is worth $5,000. And the difference between these two guys is going to be my revenues. Do you agree? Guys, do you agree? So what are going to be
Yes.
my revenues? My revenues are going to be
145.1.
yes, 145.008, something like that. 0.1.
0.01.
Oh, 145.0. No, it should be 0.08. Just to be precise. Yeah. Okay, that's it. This is the way you record a document that is a discount. So let's do 23. We sell commercial paper after 3 months. So the commercial paper, and where's my commercial paper? After 3 months, where's my commercial paper here? Oh, this one here. Okay. So my principal and my interest is 5,000 here. So basically, I receive $5,000 here, cash. And this one here disappears. Oh, and this one here disappears, this document here. Because at the beginning, it was a short-term investment, a paper. And then after 3 months, you simply execute the paper, so you receive the cash, and this short-term asset, short-term investment disappears. This is transaction 24. Reacquired capital stock. So what I mean is the corporation itself. This is the famous buybacks, guys. Corporations are using their own money to buy themselves, to buy the shares by themselves. Okay, so what we are doing here, guys, is we're going to be reducing. Where's my stock? This is going to be reduced by 2,500. Okay. However, these stocks don't disappear. Correct, guys? They don't disappear. They need to be somewhere. And this somewhere, guys, is in treasury stocks. And any treasury stock is an expense for a corporation. Do you understand? So when assets buy back, when the corporation buy back their assets, this reduces cash, reduces a common stock that is in the market, but the shares, they don't disappear in the air. Someone needs to be the owner. In this case, the owner is a corporation. So it is called something that is called treasury stocks. And what is treasury stocks, guys, disappears as an expense for a corporation. So the corporation is really doing an expenditure. Okay, this is a very famous transaction, guys, that is happening lately. So big corporations are buying back their shares. Okay. So if you can do, you can do all of them, all the remaining ones, guys. It's 5 minutes to do all the remaining ones. Okay, so let's do this. So I have a payment of short-term loan. Remember this was a loan, so I need to pay this back. So where is this one here? Yeah, so I need to pay 10,392.3. This is going to disappear two things. It's going to disappear this $10,000 here. And it's going to disappear this $392.3 here. Okay, so we are net zero. You can take a look. Oopsie, is this one here? Oh, I done something wrong. 10,000. Oh, I'm paying. So if I'm paying, guys, this implies it's a negative number. Now it should be okay. Yep. 26. Depreciation of building $4,000. Okay, so what I will do is depreciation. Okay, I can do this as a accumulated depreciation. I do this $4,000 here. Depreciation is here, and then this is an expense. $27 depreciation of equipment 6,600. The same depreciation of X. Yeah, I can do this in this account. Okay. Minus 600. Then I have 28. Receive payment for future services. So this is interesting, guys. I'm receiving payments for future services now. So I receive cash, but I haven't done anything. Okay. So this, guys, is going to be basically, I can consider this one as unearned revenues. These are unearned revenues. Okay. So this is not a revenue yet. So I cannot consider this as a revenue because I haven't paid, I haven't done the service. I just recognize this as a liability, right? Now let's do 29. Perform services again. So I use from this 10,000, I use $4,000. So basically now it's not anymore a cash. So I do this minus $4,000 here. And this now becomes a revenue, $4,000 here. And then finally, the last one, this is 29, the last one, payment of bond interest. So I pay the 900 of bond interest. So I simply 900 here, and I disappear this short-term interest. And with that, we're done. You see, in order to check if we're okay, one of the ways to check if we're okay, oopsie, here we have an issue. Why? So, oh, sorry, I need to pay 10,000. I received 10,000. I will have accounts payable and this, okay, interest payable. Oh, remember, expenses are always negative, guys. So now we have everything. All is correct, etc. Okay, what is interesting, guys, about this method here is that we have all the financial statements all together. Of course, from here to here. So basically, current assets, fixed assets, current liabilities, long-term liabilities, stockholders' equity. Up to here is my balance sheet. So your balance sheet, guys, indeed corresponds to these numbers here. So how much do you have in cash? 38,000. How much do you have in accounts receivable? Oh, why you have 3,000 negative here? So we have a negative value here that is something that is wrong. This is not accounts receivable. This is inventories. Yeah, this looks correct now. So I have 0 in accounts receivable. I have inventories 12,000, expenses prepaid 1,000, etc. Got it? So and this part here is your cash flow. This one here is your cash flow. So you have $38,000 in cash. And this part here, guys, revenues and expenses, is your P&L. And this number here, that is simply, if you sum the revenues, you sum the expenses, revenues minus expenses, this is your profitability. Got it? In this case, I'm losing 11,582.14. Okay. So with this information, guys, what we can do, and you have all the transactions here, so you can build immediately. You need to analyze, please, analyze these ones here, and then I have created the P&L. So we have net sales, and then we have here all the transactions. So you can take a look: Y43, Y25, Y30. So I have my net sales. I have my cost of goods. I have gross margin 13,000. I have sales and marketing. I don't have anything in research and development. We have general and administration 7,000, depreciation 10,000. And then I have operating expenses already is 19 minus 19,600. Income from operations, guys, is this number minus this number. So I'm losing already $5,000. I have interest income. I have other extraordinary income or expenses. And interest income before taxes is 11,000. As soon as this is negative, my taxes are zero. And I have a net income of 11,582 negative, a loss. Makes sense? And this number here coincides exactly with this number here, for sure. Got it? It's very easy. Once you have this part here, it's very easy. Now, the second one, my balance. You can see here also the formulas, guys. I have in cash, and these ones here, the balance is simply this sum here. It's simply this one here, this one here, this one here, etc. Okay, so I have $38,000 in cash. I have no accounts receivable. I have in inventories 12,200. Prepaid expenses 1,000. So my total assets, current assets equals $52,000. Fixed assets at cost, I have 150. FF&E equipment 33,000. Accumulated depreciation 10,600. So normally what you have is what is my fixed asset here is going to be the sum of all these 172,400. So my total assets, guys, that is short-term assets, current assets, plus my fixed assets is equal to 224. Now in the liabilities, I don't have anything, any account payable. I don't have any accrued expenses, current personal debt. I don't have sales tax payable. I have unearned revenue, $6,000. I have a long-term debt, $30,000. My capital stock, treasuries, and retained earnings. So this one here, guys, is exactly this piece here. This one here. This one here is the one that goes here. And then my shareholders' equity. So you see my shareholders' equity has decreased by 11,000. So my shareholders has lost their value. And then what you can see is assets equals liabilities plus shareholders' equity. And this basically shows us that we are in a good position. So, and that's it. Questions? Okay, what I will do now, guys, I will send you another file, perhaps now, and let me see. There is an additional file that I will send you. Allow me 1 minute. Look. So what is this one here? Yeah, I will send you guys one Excel file in which you can practice. Okay, you can do what I have done. I don't know where I have it, but I will find this to you for you. Oh, here we go. Accounting exercise. Give me 1 second. Let me show you. So I will give you something like that. No, and I will prepare this for you. Yes, I will prepare this for you. So these exercises are going to be here for you. Okay. And what I will do is I will provide you. So these numbers here, guys, corresponds to the previous year. Okay. So let's assume that we have these numbers here correspond to the previous year. You're going to do these transactions here. So I try to do this, just cover everything. And you have that the solution in here. Got it? What I want from you guys is to replicate this exercise. I will give you this, but try to do this by yourselves, okay? do the exercise that we have done today. You have the white document, so you need to do that. You need to be sure that you are able to arrive to what we have done today, all this part here. Make sense? And you need to do this exercise here. Let me find, yeah, I cannot do this here. That's okay. Questions. So we can stop here. Questions, guys. So remember the final exam is going to have the following pieces of the equation. Okay. So for the final exam, guys, we have the following. Where is this one? Let me move this one here. So the final exam, not the final exam, let's call it quiz 3. We are going to have dollarization, FX, foreign exchange. We have, what is the other one? Bonds. And then we have financial accounting. Okay, so we have these three guys. These are going to be the topics for the quiz number 3. Please, you need to study. I will give you the example, the exercise. So you need to practice that. You practice what we have done in class today, the Excel file we have done in class today. And of course, the exam is going to be very related to that. I've done all the transactions that are kind of typical transactions. So if you practice that, we are going to be more than safe. Got it? Questions?
Is Prof, that exam on Thursday?
Yes, the quiz number 3.
And that's our last class.
Yes, and that's our last class. Completely right. So what I will do on Thursday, guys, I will use the first, it's going to be kind of exceptional. So I will do a kind of very quick review in the first hour. Okay. Basically, we can talk about this stuff very quickly, but I will do questions. So you need to have questions. And then the second part of the class is simply the quiz number 3, the same, how do you call it? The same structure as before. Okay. So no surprises, nothing. Now, guys, I have finished grading your exams, but I have received the extra credit. So I need to review that. So if you want to know your grades, guys, please write me tomorrow, okay? But I will give you a window. Don't write me in different windows. I will not have time to answer. Please write me tomorrow from, let me see, where's my schedule here? Give me 1 second. So if you want to know your grades, where's my, give me 1 second. If you want your grades tomorrow, guys, I have unpacked here. So you need to write me between 12 and 12:30 is Eastern time. Okay, please, between 12 and 12:30, and I will give you your grades. But just between 12 and 12:30. After that, I'm packed, guys, and I will not be able to pay attention to your emails. Okay, do you understand?
Yes, thanks.
Okay, between 12 and 12:30. Just I will answer that your grades at that time of the day. Okay, guys. So I think we have done quite a lot of work. Hopefully you have learned a lot, and then we're going to have time to review a little about this last part here on Thursday. Do you have questions up to now? No? Okay, so we're all set. See you on Thursday, guys, and have a good night. Take care.
Thanks, Prof. Bye.
See you. Bye-bye. Bye, guys.